Welcome to the Zions Bank Economic Update. I'm Deb Speed, and joining me is Robert Spendlove to discuss the Fed's recent decision to raise the federal funds rate. Robert, why don't you start by explaining what the Fed decided to do at their December meeting?
So the Fed decided to raise the short-term interest rates, the federal funds rate, by 1/4 point. So they raised it from about 0.5% to 0.75%. Now that's significant because it's the second time in a decade that the Fed has raised interest rates. So we've been in an economic environment where they just couldn't do it for the past decade. And also it's significant because every Fed governor voted to make this increase. So it was a unanimous decision by the Fed.
So why did they make the decision?
Well, the best way to interpret this is the Fed is it's their interpretation of future economic conditions. And so for the past several years, while our economy has been growing ever since we've been coming out of the Great Recession of 2008, we haven't seen strong or robust economic growth. But now we're starting to see signs that the economy is picking up. On the employment side, our unemployment rate is down to 4.6%. So that would indicate an economy that's at full employment. And then also on the inflation side, the Fed's goal is to have inflation around 2%. And while we've had inflation, but it's been below that 2%, right around 1 to 1.5% for the past year or two. But now we're seeing expectation of higher inflation as we move forward. And now a reason for that is the Fed is seeing fiscal stimulus on the agenda of the new Trump administration. So we're expecting to see higher GDP growth, higher income growth, which will turn into higher inflation, which gives them an impetus to be able to raise rates.
Did the Fed give any indication what their future plans were with the rate?
Yeah, while everyone was anticipating the 0.25% increase in the Fed's rate, what did catch market observers off guard a little bit was the Fed's forecast of what they're going to do over the next year. In their September meeting, they had said that they would raise interest rates 2 more times in 2017. And in the December meeting, they upped that to saying they're going to raise them 3 times in the next year. And then they're going to continue raising those long-term rates into 2018, 2019, and into the long run. Now, it's important for them to do this, though, because our interest rates, especially the federal funds rate, have been way too low for way too long. And they're at historical low levels. And the Fed really wants to raise those interest rates back up to the normal level so the economy and so the markets can be operating efficiently. So while it was a little bit of a surprise, it is a good sign that the Fed has confidence in the long-term prospects for our economy.
What does all of this mean for individuals like you and me?
Well, you know, the Fed's actions don't have a direct impact on the individual. Again, all they don't control any of the long-term interest rates. All they control is the very short-term overnight rate. That's what we call the federal funds rate. It's the overnight rate that banks and the Fed charge each other for overnight loans. However, if you take this in the broader environment of a higher interest rate environment, we can really start to see those impacts on the individual. And what are those impacts? Well, when you have higher interest rates, borrowing costs are higher. So if you want to buy a car or get a credit card or buy a house, it's going to cost a little bit more now with those increase in interest rates. However, on the other side, for savers, while for the past decade, saving money has had almost no return, now it'll have a little bit higher return and will encourage more people to save their money.
Interesting. As usual, thanks for your insights.
Sure.
And thank you for joining us. For more information and analysis, please visit zionsbank.com/economy.